Hello, this is Brian Leising with Financial Brokerage, and today I'd like to share a life insurance sales idea that you can use if you work with some commercial accounts or maybe some business owners, and this involves key person policies. If you're not familiar with key person policies, a business will purchase a key person policy on a key person. This is usually a top salesperson, maybe their IT person who knows how everything runs. The company just would not function as it does today without that person. They're going to need some money to get by in the interim, to find and hire a replacement for that person. So that's why a business would purchase a life insurance policy like this. Now, most of these policies end up being term insurance. They don't necessarily expect the person to be there long term. They can get a 10, 15, maybe 20-year term, and that's pretty long in today's environment, and the cost is generally low. Problem comes though when that key employee leaves the company or they retire. Now the business will probably drop that policy and they have nothing to show for it. It was term, it has no value at that point in time. They've just spent the money for the premiums. There is something else that business could do to give them some advantages when that ultimately happens, because the person is going to leave for another job, they're going to retire, or they'll pass away at some point in time. So let's say the person retires. Here's what the business can do up front to plan for that. Instead of a term policy, they can get a policy that has some cash value inside there. So now the business has some options when that key person ultimately retires. One, they could just keep the policy in force. The business is the owner and they have total control over this, and they don't have to do anything else. They can keep it in force, utilize the cash, or wait for that person to pass away, then they'll still receive the death benefit. Another option, they could surrender the policy. They could keep the money that was inside there. Now the premiums that they paid in, that portion of that money that they received, they would get tax-free. They would have to pay a tax on the gain. Now that's maybe not optimal. Another thing the business could do would be to transfer the policy to the insured when they leave the company. Now that's going to be a taxable bonus to that employee, but it will give the company a deduction. And the fourth idea, though, and I think this is probably the best of all worlds, the company could surrender that cash value policy. They're going to keep the premiums, that's the money that they paid in. That part would be tax-free to the business. They can then bonus any gains in that policy to the employee that's leaving. Now that bonus is taxable to the retiring employee, but that represents a deduction to the business. So now they don't have to pay taxes on any of the gains inside that policy, and they can give their retiring employee a nice little bonus as they go away. So how do you come across these opportunities? There's a couple different ways. One, certainly when you're talking about key person policies with new clients, or this is a new policy that wasn't in force previously, but also you could use this idea when you're reviewing existing policies. Maybe you're in front of a new commercial client account. Ask about their key person policies. Do they have the old-fashioned type that's only term and they get nothing back when the employee leaves, or do they have a cash value policy that can give them some advantages when that time comes? So use that as a conversation starter. Let us know what we can do to help with underwriting and product selection and case design. We'd be happy to do that.